In this episode, we finally break down the soon-to-be-released Repayment Assistance Plan. Let's get started. Are your student loan payments or loan balances a major obstacle in your financial life? Then tune in and let's escape student loan debt. Hello and welcome to another episode of the Escape Student Loan Debt podcast. If you have been listening to the last few episodes, you are probably seeing the title of today's episode and saying, finally, this guy has been promising we're going to go through the repayment assistance plan for episode after episode after episode. Today is actually the day. As I share, there have been just a number of updates that have just kind of jumped the line when it comes to what we cover on the show, but we finally have a week where there has not been as much in terms of updates. And I'll tell you that if you're tracking along with today's episode and you're looking at our Escape Student Loan Debt Guide to Income-Driven Repayment Plans, that's something that when we update it with the new version, you have to re-download the guide until we find a way to house it online where you get those updates automatically. We will release new versions, add new information for plans, and when we do, you have to download that new version to be up to date. So if you're wanting some information on the repayment assistance plan and you want to use the calculator for repayment assistance plan and comparing it to your other options, you can go to escapestudentloandebt.com/guide to be able to access the newest, most up-to-date version. That said, we're going to be using that guide as we go through this episode and walk you through the details of, in the first half, the repayment assistance plan just in general. What's the eligibility? How do they calculate payment? So on and so forth. In the second half of the episode, I'm going to give you an idea of whether or not this is a good plan, who I think it might be a good fit for, and where I think there are some things that might seem on paper to be a good fit, but in reality are not as valuable as what they're promoting when it comes to this option. Right now, as it stands, you have access to the income contingent repayment plan, which I can't see any scenario for why you would use that plan long term. You have access to the new and old version of income-based repayment, as well as pay as you earn. After the middle of this year, you can add the repayment assistance plan to that lineup, but sometime between now and 2028, they're going to be phasing out income contingent repayment and pay as you earn. So the only options you would have remaining would be income-based repayment and the repayment assistance plan. Now, here's also something that we haven't talked about as much on the podcast that you need to keep in mind as well when it comes to new deadlines. So I have made sure that we've hammered home, if you have children and you are planning to take out a Parent Plus loan, that you strongly consider your other options after July 1st, 2026. Here's the part that I would add to that. If you are planning to take out any federal student loan, I would make sure that you are very, very comfortable with either the standard repayment plan or the repayment assistance plan, because for borrowers who take out new loans after July 1st, 2026, the only income-driven repayment option available will be repayment assistance plan. They don't even have IBR. So if you've already taken out your loans, even after July 1st, 2028, you'll have access to IBR or repayment assistance plan. But if you take out new student loans and you're trying to either have them forgiven or pursue public service loan forgiveness, repayment assistance plan is going to be the only option. So this is a very consequential decision and something that you need to understand the ins and outs of. So let's pull up the guide. If you're looking on screen, we're looking at the Escape Student Loan Debt Guide to Income-Driven Repayment Plans. Once again, you can go to escapestudentloandebt.com/guide to access this. And also, as a reminder, as you're going through this Google Sheet, if you see a cell that has a gray shade, it means that if you hover over that cell, there's additional information that you would want to read in the pop-up for that cell. We're going to go just kind of cell by cell or column by column, starting with eligibility. Who is eligible for repayment assistance plan? Pretty straightforward. To be eligible for repayment assistance plan, you have to have direct loans, either direct loans, Grad Plus loans, direct consolidation loans, but you cannot pay towards these loans with FFEL or Stafford loans as you can with income-based repayment. So if you are trying to access repayment assistance plan and you have those old FFEL or Stafford loans, you would have to consolidate them into a direct loan in order to be eligible. Next, what is the protected income when it comes to calculating your payment under a repayment assistance plan? This requires us to go through what protected income is in the first place. If you listened to this podcast in the past, you're aware that when it comes to income-driven repayment plans, up until now, all of them use a term called discretionary income. When it comes to calculating your discretionary income, your student loan servicer takes your adjusted gross income and they allow you to subtract a certain amount of what's called protected income. So for example, let's say that the federal poverty level for the number of people in your house is $20,000 and the formula for your specific IDR plan is 150% of the federal poverty level. So they take 150% of that, $30,000, and that income is protected. They take it off of the table before they calculate your payment. However, with a repayment assistance plan, there is no protected income. They do use some similar elements of the discretionary income formula, but they do not allow you to take any of it off the table before your payment is calculated. Discretionary income is found on every other IDR plan except Repayment Assistance Plan. They do not use any discretionary income formula to calculate the payment under this IDR option. So that probably begs the question, well, what do they use? If they don't allow me to protect my income, if they don't allow me to use discretionary income, how is the payment calculated? Well, there are two factors that determine what your payment will be under the repayment assistance plan. The first factor is your adjusted gross income. The second factor is the number of dependents that are listed on your tax return. So if you have two children listed on your tax return, they will have an impact on your student loan payment. If you're looking on screen, you can see that this is a gray cell. So we hover over it and you can see the calculation of that payment. When they look at the adjusted gross income under this option, there's a pretty clear line that I would want you to know, and that is 100,000 or more and then 100,000 or less. If you make $100,000 or more of adjusted gross income under a payment assistance plan, they're going to use 10% of your adjusted gross income for the first part of that calculation. It's pretty straightforward. There is no tier above 100,000. If your adjusted gross income is over that amount, 10% is the number for the first variable. Below that, however, it all depends on just how far below to determine the percentage of adjusted gross income that would be used. If you're looking on the spreadsheet, you can see that between $10,000 and $20,000 of adjusted gross income, you would only pay 1% of your AGI for that factor. Between $20,000 and $30,000, it would be 2%. Between $30,000 and $40,000, it would be 3%. Between $40,000 and $50,000, it would be 4%. Between $50,000 and $60,000, 5%. Between $60,000 and $70,000, 6%. Between $70,000 and $80,000, 7%. Between $80,000 and $90,000, 8%. Between $90,000 to $99,909. Between $90,000 to $99,999, you would pay 9% of your adjusted gross income for this portion of the calculation. Now we're going to talk in the latter half of this episode how this stair step down in terms of what you pay based on income could open up the door for this to be a good plan for certain people, especially low income earners. But you can also see based on this cliff that it can be really punitive for people who don't understand tax planning. Let's say that we have someone who doesn't understand the importance of the difference between the percentages when it comes to calculating payments under a repayment assistance plan, and they're doing their tax planning and their adjusted gross income is right at $100,000. Well, they would, because they're over $100,000, have to pay 10% of their adjusted gross income towards their loans. That would be $833 a month. Conversely, if somebody who understood the calculation came to them and said, you do realize if you can find the way to reduce that adjusted gross income by just $1, literally $1, instead of paying 10% towards your loans, you would only have to pay 9%. They would reduce that adjusted gross income to $99,999, which leads to a payment of approximately $750 a month. That is a huge difference to say that $1 higher or lower on adjusted gross income is the difference between $83 more per month on a student loan payment. But again, it calls to mind the importance of understanding the structure of your plan. Now, that's the income factor. What's the second factor? The second factor would be the number of children in your household. For the number of children in your household, you get $50 off per child. So if you have 2 children, you take that percentage of whatever you were paying. Let's go to our example of the person who earns $100,000 has 10% of that. That's $833 a month. If they have 2 children, they get to deduct $50 per child, and their student loan payment would be $733 per month. Now let's get into the minutia, some of the stuff that is important but doesn't jump out at you as much as some of the other factors. Going down to the next portion of the spreadsheet, we're going to talk about partial hardship. Partial hardship, if you recall, means that there was, for a very long time, a requirement that in order to get into certain income-driven repayment plans, you essentially had to prove that it was saving you money to be on that plan as compared to paying off your loans on the standard 10-year plan. That's no longer the case with income-based repayment. That requirement has been waived. But with Repayment Assistance Plan, there is no hardship requirement. So this means that if you, for some reason, want to sign up for a plan that costs you $1,000 a month, even though the 10-year standard plan would cost $200 a month, technically you can do it. They're not going to stop you because of that limitation. There was also in many of these plans a payment cap. So what would happen would be, and this is still the case, if you signed up for the income-based repayment plan in my example, and you reach the point where the payment under that calculation is more than what you would owe under the standard plan, you can stay on the plan, but they would bump your payment down to the standard plan payment. That is not the case with Repayment Assistance Plan. There is no payment cap. So if you're not keeping track of how much your payment could be reduced by going to the standard option, they are not going to do it for you. Next up, and this is a huge departure from the other plans, and it's the interest subsidy. The interest subsidy, as a reminder, is the federal government coming in and covering or paying a portion, when applicable, of whatever interest isn't covered by your student loan payment. Let's use an example of someone that has $100 worth of interest that's growing on their loans each month, but they're only paying enough to cover $25 of that interest. Well, that $75, if there's no subsidy, is going to add to their total balance. It's not added on to the balance, which is a distinction that we'll talk about shortly, but it's technically put in a separate interest category, and it adds to your total balance. Now, there are interest subsidies for certain plans for a certain number of years where the federal government will cover a portion of the unpaid interest. With the Repayment Assistance Plan, however, that interest subsidy is 100% in all years. This is a pretty big deal. This means that especially if you're a mega borrower and you're someone who owes $300,000 or $400,000, and there's $15,000, $20,000 of interest that's accumulating each year, with other plans, once those subsidies expire, that money is growing just unfettered. And if it means that your total balance grows from $400,000 to $600,000 over the course of 20 years, that is what it is. With the Repayment Assistance Plan, they're covering all of the unpaid interest, meaning that $400,000 even 20 years from now cannot be more than $400,000. It's going to go down incrementally even if your payment doesn't cover the interest. Now that may sound odd because you would think if my payment doesn't cover the interest, then if nothing else, my loan should just stay the same because they're covering what I didn't pay. But if I'm not paying enough to cover the interest, I'm definitely not covering enough to reduce my student loan balance. So why wouldn't the balance just stay where it is? Well, the reason it doesn't stay where it is because with the Repayment Assistance Plan, for borrowers who are making payments that either don't cover all of the interest or they're covering all the interest, but they're not paying at least $50 towards the actual reduction of the principal, the government will cover that gap to make sure your loans are going down by at least $50 per month. Let me give you an example. Let's say we have a person who has $100 of interest that's growing on their loans every month, and they're paying $125 as their federal student loan payment. Well, in that example, their $125 is covering the interest of $100, but it's only reducing what they owe by $25. The Repayment Assistance Plan, however, guarantees at least a $50 reduction in principal, so they would cover the rest of the $25 in that scenario to get them to that $50 reduction. Let's use a higher example, however, of somebody whose payment isn't covering interest. Let's instead say we have someone who has $2,000 worth of interest that's growing on their loans each month, which is very possible for a mega borrower, and they're only, I say only in quotes, paying $1,000 a month. Well, that means that they're only covering half of that interest. There's $1,000 that, if not covered by a subsidy, would be added onto their interest category. With the repayment assistance plan, not only would that $1,000 not be added onto the interest category, the federal government would cover it in full, they would also make a separate payment to reduce their principal by $50. So whereas in example 1, the federal government only had to come up with $25 to cover the difference, in example 2, they had to pay $1,050 to cover the interest that was growing and not covered by that person's payment, and the $50 reduction in principal promised by the repayment assistance plan. Next up, how long do I have to pay for a repayment assistance plan? And this is the kicker. There are some positives to repayment assistance plan for sure, especially for lower income borrowers. But one thing that you will not find as a positive is how long you have to pay before any remaining balances are forgiven. Unfortunately, the repayment assistance plan does not forgive any remaining balances until after 30 years of payments. If you compare that to old income-based repayment, that's 5 years more payments you have to make. If you compare that to new version of income-based repayment or pay-as-you-earn, that's an additional decade worth of payments before your loans will be wiped away. And then lastly, this is the big one for married couples, the married filing separately exclusion. This is something that went back and forth when it came to the version of repayment assistance plan that was proposed versus what was passed. What actually passed was the allowance of the married filing separately exclusion. So if this is something that you depend on in terms of filing your tax return separate from your spouse, so their income is not used to calculate your payment, that is something that will still be allowed under the repayment assistance plan. We'll take a quick break and we'll be back with some scenarios of who should consider repayment assistance plan. We're back, and let's dig into the calculator portion of our guide to income-driven repayment plans. We're going to go through some scenarios of who might benefit from repayment assistance plan. And I will tell you from my calculations, and this may change over time as I'm exposed to more scenarios, to me, the people who would consider repayment assistance plan are people who either some combination of earning less than $100,000 adjusted gross income and only being eligible for old income-based repayment. As a recap, when it comes to pay and new IBR, they require you to pay 10% of your discretionary income for 20 years worth of payments. Old version of income-based repayment is 15% of your discretionary income for 25 years worth of payments. And when I'm doing these models, pay as you earn and new IBR are, in every scenario that I've seen, although I could run the numbers differently and maybe be surprised, they're going to beat repayment assistance plan. But there are some scenarios where repayment assistance plan is going to beat, just in terms of payment, old income-based repayment. But you have to consider that with old income-based repayment, it's 25 years versus 5 more years of payment under repayment assistance plan. Let me show you what I mean. We're going to use an adjusted gross income for this family of $69,999. And I'm going right up under that $70,000 threshold to illustrate my point from earlier in the episode intentionally. We're going to assume that the family size is 4. So remember that under repayment assistance plan, since they have 2 children, they get $100 off their payment, $50 per child. If you look at what this leads to in terms of payments, you can see that under pay as you earn and new IBR, it's $170. Under old IBR, it's $256. Under repayment assistance plan, it is $250. Now, that's literally a $6 difference that you're saving under repayment assistance plan. But again, speaking to the importance of understanding your student loan plan and tax strategy, remember that if this person's adjusted gross income goes up even $1, then under the repayment assistance plan, they now have to pay 7% of their adjusted gross income instead of 6%. So now let's take that adjusted gross income up a literal single dollar to $70,000, and let's rerun these numbers. You will see that now the repayment assistance plan loses. Instead of having a $6 savings where you would have paid $250 as compared to $256 under old IBR, now you would pay $308 under the repayment assistance plan. So that's a $58 difference because your adjusted gross income went up a single dollar. This is one of my bigger concerns of the plan, the way that these cliffs work and how a lack of understanding amongst borrowers every day could lead to these types of increases. If you want to see what this is like with some bigger numbers, let's take this family's adjusted gross income above $100,000, because if you recall, with Repayment Assistance Plan, anything above $100,000, you pay 10%. Let's make their adjusted gross income $250,000. Let's assume that they owe collectively $300,000 in student loans. We'll keep everything else the same in terms of family size. And when we run these numbers, you'll start to see what I'm talking about at a larger level when it comes to Repayment Assistance Plan possibly beating income-based repayment for the old version. With pay and new IBR, it's $1,670 a month would be the payment. With old IBR, it's $2,506 a month. With Repayment Assistance Plan, it's $1,983 a month. So it's literally almost a $600 a month reduction in payment to go with Repayment Assistance Plan. The reason for this big gap at higher income levels is because when you have old income-based repayment, they do allow you to take away that protected income. So you get to take away 150% of the federal poverty level for a family of 4 in this scenario. The problem, however, is if your income or your adjusted gross income is really close to the protected income, you can have a low payment under old income-based repayment and one that compares to, or in some cases beats, Repayment Assistance Plan. However, the higher your income goes, that protected income is less helpful because you just earn so much money. So in this scenario at $250,000, that protected income leads to a really high payment because you're paying 15% of discretionary income under this plan. So in this scenario, while Repayment Assistance Plan does not allow you to protect any income, they're only asking you to pay 10% of adjusted gross income, which is why you see this big difference. So is this something that's a big deal? Well, I would say that an extra $600 a month is a huge deal for any family, but you have to think about that increase while also considering the fact that under Repayment Assistance Plan, you'd have to pay for 5 years longer before any remaining loans are forgiven. Let's call that Repayment Assistance Plan a flat even $2,000 a month, $24,000 a year. That means an extra $120,000 worth of payments under Repayment Assistance Plan before forgiveness that you wouldn't have had to make under IBR, which in some cases might make it worth suffering through that higher payment on a monthly basis. And I was trying to rack my brain for some other scenarios where Repayment Assistance Plan might win out. And I thought about the interest subsidy because, especially when you're a mega borrower, you can have these runaway balances where you started out owing $400,000 and 15, 20 years later, you owe $600,000 just because of the amount of interest that's accruing against that debt. And I wondered, hey, does it make sense to do Repayment Assistance Plan even if it means paying for 5 years longer so that that balance wouldn't increase because the government has that subsidy that covers all of the interest? If you're wondering why that's a big deal, it's because now in 2026 and beyond, until this is changed, and hopefully it's changed, at the federal level and in some cases at the state level, forgiven loan balances are taxable as income in the year of forgiveness. And I did find some scenarios where it would make sense for a mega borrower to pay for 5 years longer under Repayment Assistance Plan because of the power of that subsidy and preventing them from having as big of a tax bomb at the end of that period. Now, I'm going to tell you that for the next few minutes, we're getting deep into nerd territory. So if you've listened to this and you've heard enough that you don't want to pick Repayment Assistance Plan, you can just skip to the end of this episode. But if you are a mega borrower and this stuff matters to you and you do think about tax planning, pay attention because we're going to get a little detailed here. I want to walk you through the scenario of somebody who owes $400,000 at 6% interest. Now, at 6% interest, that means that $24,000 of interest is growing against that debt every year. Let's now assume that the borrower is using the income-based repayment plan along their journey, which is a 25-year journey before remaining balances are forgiven. And we're going to make some assumptions. Let's say that when it comes to the first 5 years of their journey, there is $18,000 of interest that's not covered by either their payment or a subsidy. So over those 5 years, they're going to have $18,000 per year added to their total debt. That's an additional $90,000. So they've gone from $400 to $490 in 5 years. Let's then assume that they're making a little more money. And now when you look at their payment and the interest that's growing, instead of $18,000 of interest, it's going to be $12,000 of interest that's not covered by their payments. Well, $12,000 is still significant. And if that happened for the next 5 years, that's an extra $60,000. So now they've gone from $490 to $550. Let's then assume that they're deep into their high earning career years and they're earning a lot of money, and now their payment is $18,000. So that means that there's only $6,000 per year for the next 15 years that's added onto their balance. But unfortunately, 15 years at $6,000 is another $90,000. So now their loans that started out at $400,000, by the time they're actually forgiven, have grown to $640,000. That, plus whatever they're earning that year, at least based on this year's tax tables, would put them well into the 37% federal tax bracket. So even if they didn't have any state taxes on that money, which is possible, just the tax on those forgiven student loans at 37% interest would be $236,800. Conversely, let's look at this same scenario and the same payments using the Repayment Assistance Plan. If there's $24,000 of interest that's accruing, not only is the federal government going to cover that entire $24,000, they're actually going to go $50 deeper and reduce their student loan balance by $50 per month. Now, unfortunately, they would have to pay for 5 years longer. And let's, for illustration's sake, just assume they're paying the same $18,000 per year in their latter years that our borrower was under income-based repayment. Well, for 5 more years, that's an additional $90,000 worth of payments under Repayment Assistance Plan that they wouldn't have had to make under IBR. That's significant. I'm paying for 5 years longer, it cost me $90,000. However, when it comes to the amount of balances that would be forgiven, instead of $640,000 like it would be under income-based repayment, they've had at least that $50 a month that's been used to reduce their principal on their $400,000. Over the 30 years, that reduces their balance from $400,000 down to $355,000. And first of all, at that income, they may not even be in the 37% rate. It may be a lower tax bracket, so they may be paying less than 37%. But for conversation's sake, let's just say that it is 37%. Instead of the $236,800 that they would have owed in federal taxes alone because of forgiveness under income-based repayment, the tax under Repayment Assistance Plan would be $131,350. Now you're probably thinking we still got to add in that $90,000 of extra payments. We add in that $90,000 of extra payments and it's $221,350 in total. So while that's very close and you have to think of whether you'll even care at that point in time or whether it's more beneficial to you to just not have those monthly payments, if you're looking at the total amount that was forgiven and paid, you're actually $15,000 ahead in this scenario under Repayment Assistance Plan, even though you paid for 5 years longer. Now, that's the end of me nerding out. If you asked me, am I going to be recommending Repayment Assistance Plan to a lot of people? I would say no. The likely scenario is that unless you earn significantly less than $100,000 of adjusted gross income, the only scenario where I see myself recommending this with any level of frequency is for people who are considering this plan as compared to old income-based repayment. And even then, it would have to be with the understanding of them either being a low income earner, someone who's pursuing public service loan forgiveness, and it just happens to be a lower payment than another available option, or somebody who owes just hundreds of thousands of dollars and is comfortable with paying for 5 years longer if it saves them on the total amount paid at the end, which may not be the average person. Now, that was a deep dive into Repayment Assistance Plan, but it's what I promised you, so I hope you're happy if you've been waiting for this episode. Once again, if you go to escapestudentloandebt.com/guide, you can access this for yourself. We're going to keep giving you information every 2 weeks to have your student loans forgiven, reduced, reorganized, or expedited. From Escape Student Loan Debt, this was the Escape Student Loan Debt Podcast, a show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving homeownership.